Director of the Delhi School of Economics, Professor Ram Singh, Session Chair, Professor Pamidua, distinguished faculty of the Delhi School of Economics and other colleges affiliated with the Delhi University, assembled dignitaries, press, and dear students. First of all, good afternoon, and first of all, let me thank you all for this very warm reception and a very warm introduction. I would also like to compliment the school and the director. I was in fact very happily surprised when I learned that you are doing this 2-day public policy seminar in an institution, in an academic institution. And I believe this kind of an interaction, the academia industry interaction, where herein, for you it is, especially with public policy being one stream, is very important. And so I would really like to place my appreciation for this endeavor. I'm very hopeful and confident. This is the second edition, and this will continue in future. I'm doubly pleased to be here today to deliver this lecture for two reasons. First of all, it's in honor of Professor VKRV Rao. He was an eminent personality. As has been mentioned, he wore multiple hats. He was not only a great distinguished academic, won the Adam Smith Prize, was one of the first 3 Cambridge PhDs, and a lot of scholarship, articles, etc., but also, importantly, a very eminent institution builder. D School is, of course, a beneficiary of his vision. He served as the member planning commission, and he was also the education minister, Padma Vibhushana. So I'm really, very honored to be here delivering this lecture in his memory. Second reason for my happiness is that it is at an institution which is so august, which has made so many stellar contributions to our country, the Delhi School of Economics. The people who have studied here, researched, practiced, taught here, have held multiple positions of eminence and contributed to the development of our country. We in RBI ourselves, I'm surrounded, by the D School alumni. And so in every walk of life, even in my family, there is the D School blood, which is running. And so it's indeed, therefore, a matter of happiness for me to be present here. I thank Professor Ram Singh and the DSC for giving me this opportunity to be present here and to address you all in this prestigious institution. Well, all of you have been in my thoughts the last few days. You are all, very bright, very intelligent. And so I've been thinking, what should I be talking to you about? And so first of all, I thought, I should be talking about monetary policy because that is, our bread and butter. But monetary policy, I believe, is boring. And so I changed the topic. And so I'll be really, speaking about financial regulation because that is so pervasive. That is something, which has caught the attention of media, of policymakers and researchers. And so I thought, I'll speak about this. And you're all, I know, very bright. You're all, very, very intelligent. It's important that we speak to you. You are the future of our country. And I'm sure, when I speak to you on this subject, it will hopefully trigger some interest in this very, very critical area of public policy. So I've structured my speech into 5 parts. The first part is really, about the role of, regulation making in public policy, how it is different in the financial sector, and what our objectives in RBI are when we make regulations. The second part is about the principles that we follow in regulation making, and these are very generic principles, which I'm sure will be applicable in all walks of life, in all sectors wherever you regulate, with some, of course, distinguishing characteristics that we have here for the financial markets. And then finally, I'll be talking about the challenges. A lot of people, standing over there, so you have to bear with me for about 30 minutes or so. But I hope, that this will be a useful thing for you. So you're all aware that while markets are very, very powerful engines of growth and efficiency, and as far as possible, we should leave the markets to decide and determine the course of action for all of us, for all the economic agents. We leave it to the markets, but we are all at the same time also aware that there are market failures, and that is where regulation comes in. For a variety of reasons, the markets can fail. You are aware, just to set the context. It could be information asymmetry, it could be natural monopolies, there could be externalities, and there could be consumer protection, and there could be, like in our case, systemic risks. So it's a pragmatic response to the inherent limitations of unregulated markets in specific contexts. Financial regulation is different because of 3 reasons, which I'm going to give you. The first and the foremost reason is that, as mentioned, it runs, it's like blood, so money runs all across the real economy as well. It's interconnected, like, non-financial entities are never so. If a bank fails, it has a cascading effect. Depositors lose savings, interbank markets freeze, credit supply contracts, and payment systems can falter. This impacts the entire economy, which can feed into a systemic crisis. You are all aware of the 2008 global financial crisis in the advanced economies. It demonstrated this with great clarity. Secondly, financial institutions are inherently fragile because of a maturity and a liquidity transformation. So we as savers, we deposit in the banks, for very, very short terms, but the banks then transform this and give it as loans which are generally, of longer term. So this transformation is very economically, very, very valuable, but at the same time, it creates a vulnerability. A loss of confidence can trigger bank runs, which you have seen, witnessed in our country, in other countries, converting the liquidity problems into solvency problems. An entity, a manufacturing unit can close down, for a few days, for a few months, without impacting anyone else. But a bank branch closing down, for a day can actually have a contagion effect, not only across the financial sector, but also the real sector. And third reason is that the financial markets are prone to pro-cyclicity and a herd behavior. During booms, risk is underpriced, lending standards deteriorate, and asset bubbles form. During busts, credit vanishes precisely when it is needed the most. This amplification of business cycles distinguishes financial markets from most other sectors. So these characteristics explain that why financial regulation is important, but at the same time, it is also very complex, unlike some of the other sectors, because it's not merely protecting the individual customers and consumers and promoting efficiency, as is the case with other regulations, be it in telecom or in power, etc. But they are of paramount importance because they are safeguarding the systemic stability of the financial sector and, by extension, the whole economy. So what are our objectives in RBI when we are doing a regulation? The foremost priority, therefore, as you would understand from this, which is a direct corollary of why it is different, is to ensure the financial stability in the system. Now, financial stability has been defined in a number of ways. I'll not go into it, but suffice it to say that things in the financial sector, whether it relates to the market infrastructure, the intermediaries, the markets, is working properly so that there are no crises, and the likelihood of disintermediation or disruptions is actually eliminated or minimized. So for us in the Reserve Bank, for all central bankers in fact, financial stability remains the North Star. Because while we do realize that short-term growth can be achieved at the cost of financial stability, but financial instability can have much bigger consequences for the long run. They can have much more losses than the gains achieved due to the short-term rapid growth. And while financial stability remains the bedrock, there are 4 other objectives that we have. First one is the prudential aspects of liquidity and capital requirements to ensure the safety and the soundness of financial operations in the interest of all the stakeholders, which may or may not have financial stability implications. Second is conduct-related measures for consumer protection, assistance in law enforcement, for example, money laundering, and that's an issue which has engaged our attention. All of you, go through it, whether it is for KYC, whether it is for KYC. There are a lot of issues. You're all aware, but then this is a necessary kind of an evil that we have to go through. And then there are the broad socio-economic objectives that we have, for example, the priority sector lending objectives. So what are the key principles for us in financial regulation? There are 5 of them. I'll go through them one by one. First, principle-based formulation. Second, regulations should be proportional. Third, and this is where your role becomes all the more important, the role of researchers, academicians becomes important. Is that how can it be more and more evidence and data-based? And again, consultation is a very important principle that we follow in all our regulations. How it's important, I'll get into those. And then a regular review. So now we have come up with a framework in May this year. We formalized what we were doing through a framework which we have put out in the press for everyone to know, and also for us to ingrain in our and embed in our policy making and regulation making. So what is this idea of principle-based regulation? Well, it's quite simple. The name suggests so. And it is basically one where you are now focusing on the rules. You are focusing on the outcomes and not on the rules so much. It uses very high-level statements or principles rather than rules so that it is applicable across various entities, across various circumstances, and you don't have to again and again change them and update them. And often it will have explanations of the intent behind the regulation, and it will be mostly qualitative and not so much quantitative. Rule-based regulation, on the other hand, uses specific statements to define requirements that entities must meet. These necessarily focus on specific areas and tend to use quantitative terms. If one was to draw an analogy with parenting, the explicit to-do list that we give to children when they are very young, do this, do not do that, is like a rule-based regulation, while when they grow up, you give them broad guidance, which is more akin to a principle-based regulation. So the world over now, the global discourse has been to move towards a principle-based regulation for reasons of simplicity over exhaustive specification, which may not even be possible. Not only is it not possible, but it can also lead to a very creative way of complying with the regulations, adopting a tick box kind of an approach that, yes, we have complied with these, and these provisions of the various regulations, and not serve really, the outcome. On the other hand, principle-based regulations will have one risk, because if they are too generic, then they are subject to interpretation not only by the regulated entities, but also our supervisors and those who have made them, which is the regulator itself. So to have, so it's not really, very straightforward as to how we achieve this simplicity without losing the intent and the outcome and without losing, the outcomes and the benefits thereof. So in RBI, in our country, what we have done is that we are gradually moving towards a principle-based approach, but retaining some of the rules that were already there. So it's a hybrid approach that we are following. You would have heard recently in October, and even before that, we introduced for the NBFCs first and then later on for the banks, expected credit loss. So Mekanti is here, Sugato is here, and some of you also, I'm sure, would recall what ECL or expected credit loss mechanism is. Some of the students perhaps may not be aware as to what this is about. So let me just in brief tell you that this is basically about provisions. It's about proper accounting by the banks, because the banks, you are aware, are required to keep capital buffers for abnormal times, and to be able to calculate correctly the capital buffers, the accounts have to be also, cannot be fudged, they should be maintained properly. And so there are provisioning norms which we have given out. So earlier, when we started this, we were very specific provisioning norms, for the expected loss that is probable, that can happen over the year, next year. And so recognize it early so that the balance sheet, the accounts, reflect the financial situation clearly. And so they were very rule-based. So they would say that, okay, if a project is of, say, commercial real estate, so that would be, I think, 1%. So whatever is the total loan exposure, provide 1% for it. If it is residential housing within the real estate, I think it is 0.75%. If it is MSME, provide 0.25% aside, because there can be losses. So it was very, very, and then if it is non-standard, it has become an NPA, then, starting with 15, next year 25, 40, and so on. So it was rule-based. But what is the outcome that we wanted? The outcome really that we wanted is that whatever is the loss that is expected should actually be accounted for. Now, is the loss going to be uniform and standard across entities which have very different project appraisal norms, very different segments also within subsectors? Should they all be providing for the same? And whether they are over-providing or under-providing for it, it was based on averages. So we moved out now to more a principle-based regulation, which basically says that provide sufficient provisions. Now that's very simple, of course, but it is subject to interpretation. And so we have told them, so we have given, detailed guidelines as to how they should be calculated, what is the methodology to calculate it, how do you look at the probability of default, how do you look at the recovery rates, how do you look at your own experience, and then provide for them basis each and every individual entity's own experience and history. Again, here it obviates the need, while achieving the outcomes on the one hand, it obviates the need for updation as and when things change. So we have moved towards this, but again it's a hybrid because we are still moving because we just started this journey. Secondly, proportionality. We have a very, very diverse financial architecture in our country, NBFCs of various scales, banks of various scales, size, complexity, different nature of products that they are offering to their consumers. And so therefore they have to be proportionate. Our regulations have to be proportionate. There cannot be a one-size-fit-all regulation for everyone. So more the complexity, more the scale of operations, more are the stringent the regulations, and vice versa. This fundamental principle finds evidence not only across our regulated entities. NBFCs have different regulations vis-a-vis banks, within banks, those which are systemically important like SBI and two more. They have even higher stringent regulations. But within an entity also, depending on the risk of each type of activity that is recognized, and regulations keep this proportionality in mind. The third principle is consultation. And so every draft that every regulation that we issue first is in the form of a draft. Of course, when we issue this regulation, and this is important, not only for our regulation, for any regulation, even for lawmaking, the government also, does this process of consultation. They put their laws, draft laws, on their website. They invite suggestions, comments from the various stakeholders. And similarly, we also do this. Of course, before doing this, there is a lot of internal consultation. We try to give out a regulation even if it is in the draft stage, in such a way that it is almost mature. There is a lot of internal discussion. We encourage constructive criticism, questions being asked, how it can be improved, and it's only after that it goes for a public consultation, because we do believe that we do not have, I've said it earlier, we do not have the monopoly of all knowledge. The more we believe, and that's true for any decision that you take, whether in research, when you put forth a hypothesis, and then you come out with the conclusions thereof after doing your research, and you realize that this is the result, but you try to triangulate, you try to validate through other sources as to whether it is matching with others' perception, expectation, or with reality. So the process here is very much similar. There is a lot of asymmetry in information, that we have, our stakeholders have, other people have. And so it's very important that while, we look this through our own eyes, it's important that it's looked through the eyes of others. It bridges asymmetry of information, as I have said, but it certainly improves regulation making. So every regulation that we put through now is in the form of a draft of inviting public consultation. The fourth principle is, again, that it is evidence-based. As far as possible, we try to be evidence-based. It's that method which calls for preferring facts and credible, relevant evidence over just an opinion, intuition, anecdote, and common sense. to take decisions. While we may not have at our disposal, and it is perhaps not amenable to it, the rigorous approach of randomized controlled trials, which Abhijit Banerjee and others have popularized. The attempt is certainly, inspired by looking at evidence as to what works, what doesn't work, and how it can work better. Now, this is very difficult. This is very challenging. You all are aware, especially in the financial sector. And so sometimes, of course, we do use international standards, which we customize to our regulation making. So our revised guidelines on project finance, they emerged from careful study of the default rates, recovery rates, and the cash flow characteristics of such lending by banks. Another example, we amended the LCR requirements recently, which is the liquidity coverage. I talked about provisioning. This is liquidity. When you put your deposits in the bank, the banks are required to maintain liquid assets, not lend them all in the form of loans, which are then difficult to recover when someone goes to the bank to ask for money. So we have liquidity requirements, and the liquidity requirements have again been refined on the basis of our experience of the runoff, the expected demand for such deposits in times of need and in times of crisis. Similarly, we increased the risk weights. You would have heard post-COVID, we increased risk weights for capital requirements. That's the third thing. Talked about provisioning, which is about accounting. I talked about LCR, which is about liquidity, and then capital requirements for abnormal times. What is the kind of capital that the bank should actually be keeping? And this we revised during the crisis, post the COVID, when we realized that there is higher amount of credit going to a particular sector, which could cause stress. As soon as that stress was relieved and it was shown, in the data, basis that evidence, we retracted it back. That's the fourth principle, which is use evidence, use data to draw up your regulations. The fifth is regular review. Now, this is again, very important for everyone in daily life or even otherwise, to review whatever decisions, whatever orders, circulars, laws that have been put in, because regulations are made, with a specific context in a particular circumstance. And in this rapid age where technological transformation is happening at tectonic speeds, it's very important that as soon as the context changes, we are agile enough to look back into those regulations and see as to whether they need to be fine-tuned, they need to be reviewed or not. It is especially important to do a regular review, to put in place a system, because one is not actually going to, first of all, realize as to when these needs change. Many a times one may not realize. But the other important reason is that there is a stickiness to it. There is a proclivity of everyone in society in day-to-day affairs, and even in our work, in any organization, for that matter, for no change, for status quo. So we all, like to be status quo. So if there is a particular chair, in the dining room that you are used to, you will always sit over there and not change it, because you are so used to it that even that small discomfort, and if someone from outside, some guest was to sit on it, you would find it very uncomfortable. And so there are various experiments which have shown this, both in lab and outside, that status quo, once you are given a default, and those experiments, give out various options. One of the experiments, for example, gave an option to the participants, to the respondents, as to their preference for out of the various medical insurance schemes, which one would they prefer. And then there was another set, it is kind of a RCT, and another this gave a default, that this is the default. And they realized, obviously, that the one where they had given the default, that was picked up more. So whether it is in labs or whether it is in actual experience, status quo is such a inhibiting factor for reviewing anything. It's important that we embed it in. And this is true, very much for the financial sector, whether it is the IMF, whether there are, seniors and very experienced officials from BIS like Claudio Borio, who says that the fear of going against the manifest view of markets can have a powerful inhibiting effect. IMF talks about the biases in favor of inaction when talking about macroprudential regulation. Roberto Romano of Yale Law School talks about what he calls an iron law of financial regulation. Every financial crisis, he studies 3 of them, starting with the Great Depression, is based out of US experience, and they find that the regulations post-financial crises are very different. They are more complex, and they are not only complex, but they are also more prohibitive. Now, the question is not really as to whether they were correct or not. The question is that this creates a whole maze of laws, and if I may use the term economic ratchet. You heard economic ratchet, right? So it works like that. So there's only one way that it can go, and which is add more and more and more of regulations onto existing ones, creating the system very, very opaque and complex. So what it means really is that you got to review these regulations every now and then. And so we have this FSDC, the Financial Stability and Development Council, under the chairmanship of the finance minister. Recently, a few months ago, all the regulators under the chairmanship of finance minister decided that we will be reviewing all our regulations at least once in 5 to 7 years. And a number of announcements were made for those who are following the banking sector in October. Many of those are in the spirit of this review of regulations, some of them which had actually become totally outdated. Some of them had not been reviewed, even though because they were related to the size of the economy. But the size of economy over the last 26 years, like the the lending against securities norms had not been changed for 26 years. And so with the evolving circumstances, many of them were reviewed and fine-tuned. Come to the last section of my lecture, which is what are some of the challenges? There are many of them. Let me highlight 5 of them. The first challenge is to balance the cost and the benefit trade-off. While regulations do offer benefits in terms of stability, consumer interest, etc., they come with a cost. We got to recognize that while it is in our interest to promote consumer protection, to promote financial stability, but like there are no free lunches. I've said this earlier. Regulation too is not devoid of costs. There are trade-offs between the benefits and efficiency. So we keep this trade-off in mind while formulating regulations. We attempt to strike the right balance, keeping in view the benefits and costs of each and every regulation. This has again been embedded in our regulation-making framework, which I talked about earlier. And before releasing, therefore, whether it is in the form of a draft or a final regulation, we try to assess and estimate the direct and indirect impact of our proposed regulations. The calculations may be difficult in many cases where we tend to rely on estimates, but this is certainly important so that the cost of regulation is actually not weighing down the benefits disproportionately. A subset of this issue is, and you hear of this, especially in this era when so much of financial innovation is continuously happening, and that is whether to regulate it or to not to regulate it. And so this is a very deep question which needs a judgment about the benefits, potential benefits and the risks. And it means that we have to use this judgment every now and then, which we have done. For example, stable coins, cryptos, they have a huge risk, and so we are adopting a very cautious approach towards it. But at the same time, when it comes to digital innovations like UPI or digital lending, our stance has been very accommodative and very enabling. A related dilemma in this regard is how much innovation to permit when its risks are not fully understood. We have the RBI's regulatory sandbox approach, which represents an attempt to balance the trade-off, creating controlled environments where innovations can be tested under regulatory oversight before they can be scaled. Of course, there are issues relating to refining it as to when an innovation has actually attained maturity and it can be put to scale. Those questions are there, but this is an approach that we have talked about. Having allowed a particular innovation into the system, how do we actually bring it on ground? The fourth, again, I hinted at it as to how financial regulation is different, and that is the pro-cyclicity. Many of our regulations, whether it is mark-to-market, accounting forces the institutions to recognize the losses during the downturns, potentially triggering fire sales, and similarly capital requirements, if not designed carefully, can force deleveraging precisely when credit is most needed. For this, the Basel III framework provides for counter-cyclical capital buffers, and even in our country now we have a framework for providing for such counter-cyclical buffers. Of course, we have not yet got an occasion to use it, but it's there to take care of this counter-cyclicity. The fifth and the last challenge before I conclude is with regard to implementation, whether we should discipline and enforce strictly, or whether that can actually threaten the broader financial stability. This is because there can sometimes be a temptation for forbearance. We have grappled with this. You are aware prior to the AQR that we did repeated restructuring schemes, hoping that these stressed assets will be, through forbearance, through restructuring, can be made normal. That did not work. We delayed recognition. It caused a lot of problems. Similarly is the question of loan waivers. Sometimes loan waivers are given, hoping that this will improve the discipline of the lender, but it may not happen. So our approach here is very, very clear. That forbearance should be only exceptional, as we did it during COVID. You are aware we have done it now recently for the trade measures, but again, there is an end date to it. There is a last date to it, so that it cannot be misused, and it does not become a substitute for addressing the underlying problems. Let me conclude. The intent of this detailed treatment of the topic is to expose you to these diverse set of issues. Hopefully they will ignite some interest in this complex area of regulation making. As you advance in your academic and professional journeys, I encourage you to view regulation not as a static set of rules, but as an evolving discipline that responds to changing markets, technologies, and risks. Effective regulation certainly requires technical expertise, but also judgment, humility about what regulators can actually do and cannot, and constant learning. The Reserve Bank of India is trying to continuously adapt. We are vigilant and alert to emerging risks and evolving conditions. We are encouraging innovation while being mindful of our regulatory objective of safeguarding systemic stability. We are trying to simplify regulations where possible while maintaining the necessary safeguards and guardrails. We are strengthening coordination with all other regulators, while at the same time respecting the jurisdictional boundaries. We are trying to enforce rules consistently while recognizing that there can be circumstances which will warrant flexibility. These tensions cannot be permanently resolved. They must be continuously managed. Managing this requires not just regulators, but informed citizens, responsible financial institutions, engaged students, engaged scholars, and yes, bright students like all of you over here who will, I am very confident, shape the future of Indian financial system. Achieving good regulatory outcomes is always a collaborative effort by the government, amongst the regulators, the regulated, and the broader community. I wish you all a great success in all your endeavors. Thank you. Namaskar. Jai Hind.
Thank you very much for a very comprehensive and insightful lecture on financial regulation. You have covered various aspects, and I don't want to take away the time from students who are waiting anxiously for the question and answer session. But I want to say something that I think many in the audience were expecting some description on monetary policy, giving the upcoming committee meeting in the first week of December. So I think by not saying anything about monetary policy, you have increased the suspense and the excitement, and we are all waiting anxiously to see what would happen to interest rates and why it would happen. So,
Two members of the MPC are
yes,
also here.
That's you.
So, I can't preempt what the MPC has to say in early December.
But true to their responsibility towards MPC, they are very secretive. They don't tell us anything. We can't bribe them also. So I think with your permission, if we can start the Q&A session. This is exclusively for students, and I'll request Professor Ram Singh to conduct the session.
Thank you. Thank you, Professor Dua. I want to thank Honorable Governor for giving us an excellent overview of the type of activities, roles that RBI performs. It's a unique full-service central bank. I'm sure many students did not expect that RBI governor is also a discipliner engaged in law enforcement. And there have been several things that have come out during your lecture, that in addition to setting interest rates, deciding on liquidity, and also ensuring financial stability, it is RBI's job also to take lead in ensuring coordination among regulators. I want to give 2-3 points for you to reflect while students organize their thoughts to ask questions. First point is that you mentioned the shift in RBI's approach towards regulation from a rule-based to principles-based regulation. It is good, it is a compliment to our economy, because generally we see such a shift happens when economy becomes more advanced. It becomes more complex, but also actors, both regulators and regulated entities, become more mature. At the same end, this approach, this shift from rules to principles, also poses trust among the regulated also. But it also makes the verifiability, it shifts from ex ante control to ex post accountability. This in turn requires a lot of capacity building improvement among the regulators. So therefore, the question is RBI working on capacity building so that ex post verification are sufficient to make sure that we remain on the safe path, we get where we want to get. The second point that comes out, very interesting observation you have made, is about nudging. It's kind of preference for status quo, and therefore the need to nudge economic actors from status quo to where we want them to go. One issue where nudging is required is the proclivity of borrowers, project developers, and also private capex also, to rely on bank credits to fund their projects. So is there some nudging that is going on at the level of RBI? And perhaps I will stop here to check if students are ready with questions already. Yes, very good. So we will.
So if you I may forget your comments before the students can come in. I mean, very valid and very, very pertinent points you have raised on policy making, as to, from, and you have put it very correctly, that principle-based regulation policy, which actually shifts, from ex ante to ex post. And so that's a constant question, that we ask. And the point that I mentioned, before we are doing finalizing the regulation, we do a lot of internal consultation. And in that internal consultation, our supervisors who are to actually implement these regulations, so there is a separate department for regulation, there is a separate another department for supervision. So they sit down and they see, as to this regulation, they'll be actually able to implement, whether it's actually explicitly clear ex ante or not, and it will enable them to implement it with the correct interpretation and the spirit behind it or not. So that's embedded in it, number one. Number two, whenever we do this, for example, I gave the example of expected credit loss for provisioning. We give sufficient time for the regulated entities to run those principles without even implementing them, so we first did a discussion in which, we laid down certain draft rules as to how it should be done. And they tested it, they gave us the results, and we checked it as to whether there is actually correct understanding, whether there is correct implementation, there is a uniform application across regulated entities. Only then, we finalize, once we know that, yes, people have understood it. That's the attempt. We start small, we make humble beginnings, we make baby steps. We started with NBFCs. When we did this ECL, again, to put this in context, to take this example, before implementing it across the whole of the financial system that we regulate, we first tested it out on some of the NBFCs, so made it applicable for them. We saw what its impact is, what the evidence is. Is it helping us or it is not helping us? Is there a fine-tuning to be required? And so there is a lot, and the question is a very, very relevant, valid question, and that is deeply discussed and debated. The language, undergoes many iterations before it is actually finalized, and capacity building, as you mentioned, is again, very important component whenever we try to move from a rule-based regulation to a principle-based regulation.
Thank you, sir. Thank you. That gives us a lot of comfort about the direction we are heading for. Yes, questions from students. We will start from this block. So please bring mics to this block. We can start with the girl student back there. And we will take questions from this block first, and then we will come this side also.
Good afternoon, sir. Thank you so much for an insightful session. I wanted to ask two questions. First being, you mentioned the concern of economic ratchet, where regulations keep increasing and systems become opaque. How does the RBI balance the need for stability with avoiding over-regulation? And the second question is, does the RBI plan to incorporate climate risk stress tests or green capital requirements in supervision? Thank you so much.
So we take, so depending on where the mic can reach easily, so here, you are there. So we will take 3-4 questions and then.
Hello, good afternoon, sir. My question is how India can adopt to unconventional monetary and financial tools that work in pragmatic way without weakening the credibility or blurring the line with the fiscal policy, given the complexities of financial and monetary complexities that you have mentioned in your insightful lecture. Thank you.
Okay, so you are requested to repeat your question and also state your name. Introduce yourself briefly with name and department.
Okay, sir. Good afternoon, sir. My name is Nishu. I am from Sociology Department, and my question to you is that how India can adopt to unconventional monetary and financial tools such as targeted long-term repo operations, forward guidance programs, without weakening the credibility and blurring the line with fiscal policy. And sir, a very curious question from my side is that it would be great if you answer it. Should India revisit the inflation band for the inflation target framework that we have set to balance the price stability with the growth and unemployment, given in the complexity of financial and monetary ecosystem that you explained during your lecture? Thank you for the lecture, sir. Thank you, sir.
We can take one more question from here. We will. Oh, okay. There's a mic there. Yes, please go ahead.
So sir, my name is Raghav Agarwal and I am M.Com Finance student from Department of Commerce. So sir, my question is, as we see that there is some decline in Indian rupee from last few years as compared to US dollars. Earlier it was something around 80 and now it is something around 88 to 89. So sir, what is the basic reason behind the decline of rupee as compared to US dollar? And in future years, if we see the growth in rupee, so what is the basic reason behind decline of rupee?
Got the question. Should we take one more? So we take one more question from here. Can you bring the mic here?
Sir, I am the final year student at Ramjas College studying economics, Apurva Anand. Sir, do you have any particular view on the continuous debate that goes around the components of inflation? There are like food inflation that also comes into this. So do you have any particular view on that? And so can you give any few tips on how to become the RBI governor?
Very good. So now over to you.
So I was asked the same question when I went to my own alma mater, IIT Kanpur. And so I said that, you know, this is something that you can't actually going forward predict. So do your karma. And as Steve Jobs said, you know, the dots will connect only, you know, when you look backwards. Going forward, you'll not be able, don't look, you know, at the results. Do your karma, do your work, do it with passion, do it with hard work. The dots will connect. But on your question on rupee, so first of all, see, we do not target any level. Why rupee is depreciating is because of the demand. It's for the markets to decide. And so why the rupee depreciates is because ultimately it's a commodity, right? It's a financial instrument, and there is a demand for dollars, and if the demand for dollar goes up, rupee depreciates. If the demand for rupee goes up, dollar comes down, then it appreciates. That's the simple answer. But The underlying thing is, well, how does this demand change? And the demand changes because of the capital flows and the current account flows, both. So the recent depreciation that you have seen is because on the trade side, you have seen that there are some tariffs, some additional penal tariffs, as a result of which expectations have built up that our trade deficit may go down. Now, whether it will happen or not, because a lot of it depends on expectations, and that is one. Exports did come down, as you are aware, in the month of October, so it's to do with current accounts. Similarly, on the capital account, you are seeing that the flows this time round, and that's been the case, right? So somewhat muted, as a result of which. But we are quite confident that there will be a good trade deal, hopefully, going forward, and that should relieve whatever pressure has been there on our current account. We have very good buffers of foreign exchange, 690 billion US dollars, and so that's not a matter of concern. Then there was a question on the inflation band. So we have, we have a band. We have a point target with a band. That band is to provide the flexibility, and the flexibility is provided because we have a very high component of food, and we have a very high volatility of prices, especially because of food prices. And so that's why we have a higher band, plus minus 2%. I would not like to give our view right now because the review is in process, and we will give our recommendations after we have done this. We have done the consultation and we have formed our view, and we send it to the government. It will be inappropriate on my part to give the views of RBI when this process is actually going on. Someone mentioned about the targeted the liquidity that was LTRO that was conducted for certain sectors, and its impact on financial stability, or on the fiscal, on the financial stability side, I think was the question. So see, primarily for this reason, that it can have financial stability consequences. Whatever liquidity was provided during COVID, it had an end date. And so whatever excess liquidity was given, that excess liquidity was sucked out. And so we are very mindful. As I mentioned to you, it remains, the guiding principle, the main objective for us, the North Star for us, whenever we are taking such measures. But this is done only in exceptional circumstances and not otherwise. Then there were the first lady had asked some questions. What were your questions? Something on the economic ratchet?
So like how then we can ensure that there is no over-regulation?
Precisely, that's the answer I gave, that you have to put in system a place that every 5-7 years, I'm going to, whether there is a need or not, I'm going to look into those regulations and see whether you actually need them. See the evidence as to whether those regulations are actually now today needed or they are not needed. So for example, we had put in place a regulation which said that while there are exposure norms, you can't lend, a bank cannot lend, or even, bank, even NBFC cannot lend beyond a certain percentage of their capital to any entity. So we have norms, which is called the large exposure framework. You cannot lend, because if you lend to one, you are putting all your baskets. So you need to diversify. So from diversification perspective, there is a large exposure framework. And on top of that came another regulation in 2016, which said that, okay, each individual cannot have, but as a system, The whole banking system together also cannot have more than 10,000 crore of lending, because at that point of time, you are aware there was a lot of stress in the sector. The health of the banks was not good. There were losses. SBI chairperson mentioned in 17-18 they were in a loss, and today they have huge profits. The total profits, I think, of the public sector banks itself is to the tune of about 2 lakh crore or something now today, and they were in a loss. When circumstances change, you got to review them. And how do you review them? Only if you put in process a systematic process that come what may, I'm going to review this every 5 or every 7 years periodically. I hope I answered your question.
Yes, sir,
Thank
definitely.
you.
Thank you so
Yes,
much.
Thank you, sir. So we will take some questions from this block. Before we start questions from this block, let us know up there in the balcony if there are some questions so that we can have a mic sent upstairs. You are very satisfied lot. There's a question there. Okay. So please take one mic to the balcony. In the meantime, okay, so let's start from Rashid. Do you have a question? Then there's a question here. So you are closest to the mic.
Good afternoon. Good afternoon, sir. My name is Mahmood Rashid. I am a PhD scholar in Department of Economics. So you discuss about financial stability and liquidity coverage and regulation. So my question related to these. So there is a wide concerning widening gap of deposit and credit ratio, and also we see that we see that there is a structural shift in the deposit composition, and how does RBI poses these challenges, because in the medium and in the long run, because it raises the funding cost also, and also the term deposits. And
I think Rashid, just yeah, we got the main idea behind your question. So we go to another question.
Good evening, sir. I'm Avral Agarwal from FMS Delhi. You briefly touched upon how India has historically taken a very cautious stance on crypto and virtual digital assets, with strict regulations that we believe have driven capital and innovation offshore. With the US now moving toward a more innovation-friendly framework through proposals like the Genius Act, which is aimed at strengthening the global influence of dollar-denominated stablecoins, does the RBI foresee a re-evaluation of India's regulatory approach so that we remain competitive while also safeguarding the financial stability?
We can take one more question from there. Yes. So is there?
So my name is Surya Prakash from Department of Commerce. So Governor, back in 2018, when the US Federal Reserve attempted quantitative tightening, it created significant volatility in emerging markets, including in India. So given the central banks globally are again navigating tight monetary policies, which specific lessons did the RBI learn from the 2018 episode to better insulate the rupee and domestic liquidity these days?
Okay. So the first question is the mismatch, or the shift. I think what you mentioned was the shift that is happening from bank deposits towards other money markets, or mutual funds, equities, etc. Now see, this is quite natural as our country progresses, and this is something which is natural. I would not say that it is something to be rejoiced. I don't know, because if it happens too quickly, then that's also not good, right? But certainly this move is towards more of equity, etc., more other markets. That's not a bad move per se, and it will happen as it has happened, across the world. It will happen even in our country. Bank intermediation over the years, if same trends will continue, and that will decrease the share of bank intermediation, not necessarily decrease the growth rates decrease the growth of the banks because the needs are actually quite high. So the banks will continue to grow. Possibly the share thereof in intermediation will come down, but that's happening. But it's best happens if it happens slowly. And at the same time, the other thing is also happening on the lending side also. So a lot of the corporates and NBFCs are now moving from bank borrowing to corporate borrowing and market-based borrowing. So it's not only on the liability side, but even on the asset side, this shift is happening. So the point is that it should remain balanced. The second question was on crypto, and on crypto, you see, of course, US has now come out with a Genius Act. In our country, we have been promoting, number one, you are aware that our country is very different from the US in the sense that we have a very sound system of payments. We have the UPI, we have the NEFT and the RTGS, which the US does not have to the extent and scale that we have. So the payments problem, the domestic payments, the issues that they have is not there with us. But yes, we are promoting and experimenting with CBDC because which is a crypto which is backed by the central banker, by RBI, and that's as an alternative, first of all, to payments within our country, and more importantly for wholesale payments and cross-border payments. So that is the second piece, with regard to crypto, and that's why we have a very cautious approach towards crypto, and because of various concerns that we have a cautious approach. Of course, the government has to take a final view. There is a working group which was set up earlier, and they will take a final call as to how, if at all, crypto is to be handled in our country. And then there were some lessons, every crisis, we learn lessons. It's a continuous affair for us as to how we learn from each lesson. And this journey that you have seen over the last few years, 7-8 years, the kind of measures that we have taken are all, in response to the lessons that we have learned through various crises, including the 2018 crisis that was mentioned.
We take, this is the last round of questions. We take a question from the balcony.
Good evening, sir. Good evening, ma'am. Governor, sir, I am Avitosh, first year MA economics student. My question is, from a student perspective, I am curious, what are the different future milestones or enhancements RBI is planning for Mule Hunter AI, especially as more banks have started using it? What upcoming priorities or regulatory steps is RBI considering to improve its interoperability, ensuring privacy and compliance?
So, in this Q&A is reserved for students. But with your permission, I am tempted to ask one question, and you can ignore it because the session is for students. A follow-up question, another question related to banks is the big banks. There's a lot of discussion around, how big Indian banks should be. And many people feel that India should have more of big banks that have international stature. Within RBI, what is the thinking going on this issue? How many big banks you think will be adequate number for our economy at this stage? And given our aspirations of Viksit Bharat by 2047, that also requires our banks to have international profile also.
So the Mule Hunter is a project. So this is an issue, first of all, for us and for all of us, not only as regulators, but all of you as well, which is the digital fraud. So all of us need to be aware and very, very vigilant and alert to these frauds. Most of these frauds happen when, number one, we are careless, we share, the credentials, OTPs, etc., or we become greedy. There is a scheme. A lot of the frauds, especially in terms of value, high proportion thereof is because of such kind of schemes which entice us to invest and garner huge returns. So this is of concern to us. Mule accounts helps in channeling, this money and siphoning off this money. So we had our intermediate milestone was of 20 banks to adopt it. I think we are quite near it. It's in high tens. I mean, it's in high double digits. Over there, we are well on target to achieve it. It has a good success rate. It will help over there, but apart from that, also we are taking a number of measures, including better coordination with the I4C, which the Home Ministry runs. This is something which we are constantly reviewing at my level, at DG level, as to how to improve our whole safety and security of the payment banks and the payment system. Big banks, well, we don't have a number really on the number of banks that we would like, as many as possible, and that will happen. That will happen as our banks grow, as our economy grows, which has been growing at this pace. And there are many banks in the public sector area, even in the public sector space, in private sector. The pace at which they are growing, I think it's only a matter of time that we will have a number of banks, quite a few banks, in the top 100 banks of the world. Thank you.
Thank you, sir.
Thank you very much, sir. Thank you especially for your generosity in terms of time that you have given the students here. You can see our students are very bright, very curious, very enthusiastic, and they still have a number of questions to ask. But we'll do that in your next visit to the Delhi School of Economics. So thank you very much for your presence and your patience.